Hello, this is Brian Rezny, president of Rezny Wealth Management. We've got a great show for you this morning. We're going to talk a lot about the economy, the investment markets, and we're going to make sure we educate you so you stay away from those bad investments you should never be involved in. Remember, Wall Street banks and insurance companies really should be inspected before you ever invest a dime in any of them or with any of those firms. Always look for a fee-only fiduciary money management firm if you're going to entrust your money with somebody as a fiduciary. Remember, no bank, no Wall Street firm, and no insurance company is a fee-only fiduciary. Most of them sell products for commission, and most of their interests are much different than your interest. So make sure before you hire somebody again to manage your money, make sure they're legally working in your best interest as a fee-only fiduciary. You know, today's topic, I want to talk a little bit about annuities. And I'm going to talk about why annuities are bad for your wealth and your retirement. The reason I want to talk about annuities is it's really the number one sold investment to most senior citizens and even investors before they retire. Why is that? Are they good investments? I would say absolutely not. The reason annuities are sold is because the lavish commissions they pay the selling broker. Some of these brokers call themselves advisors. They're really salespeople of investment products or annuities they are required to sell. Before you ever sink any of your hard-earned dollars into an annuity, thinking there's a promise at the end of free money bonuses or high rates of return, make sure you read the fine print before your money is locked up, maybe for 20 to 22 years. Sky-high yearly fees take away from your returns. By the way, all annuities, there is not one annuity out there that doesn't have some form of an expense ratio yearly. In fact, a lot of annuities have expense ratios that approach 3.5% to 4.5% a year. Think about that. 3.5% to 4.5% a year is stripped away from your returns on your money when you invest in many annuities. And don't falsely believe that your annuity is different. All annuities have fees. Some are higher, some could be a little lower, but I will tell you, in my 30 years of managing money, I've reviewed hundreds, if not thousands of annuities, and I'm yet to see a quality annuity that you would want to invest in as an investor. The fees strip away your returns and ultimately strip away your retirement income that you desperately need. So don't fall for false promises from an annuity salesperson, and don't fall for a free dinner at a steakhouse in order to sell you an annuity. Big surrender penalties to get all of your money. You heard it. Some as high as 22% for up to 22 years. Now, sure, there's some annuities that allow you a penalty-free withdrawal for 1% of your annuity, but the vast majority of annuities have very high surrender penalties to get all of your money. Why do insurance companies impose surrender penalties to get all of your money? Simple. Because you do not want to be hit with a surrender penalty, because that's going to hurt more than leaving it into the lousy annuity you purchased in the first place. And insurance companies know that. So why would you ever buy an annuity that has a surrender penalty? There is zero reason, unless you're trying to make the insurance company rich and the selling annuity salesman of that product. No free money. I hear this all the time from various commercials on TV and the radio. These annuity salespeople will tell you, hey, you get free money. There's free money bonuses. There's this high interest rates of 8%. There is no free money with annuities. There's just a sucker's bet. Bottom line is, if you don't read the fine print, you'll never realize that there is no free money with annuities. But unfortunately, a lot of unsuspecting seniors don't read the fine print and unfortunately invest in annuities hoping for free money that never comes. No free money bonuses either. I will often have people come into one of our offices and discuss annuities they were sold by other firms. They're disgruntled, they're unhappy, they're not making the kind of money they were promised by, again, the annuity salesperson. They tell me, I was supposed to get a free money bonus of 10%, but I realized it wasn't free money at all. In fact, most of these insurance companies that give you bonuses, they actually have a yearly expense ratio attached to the bonus. A yearly expense ratio to get a free bonus? Of course, it's not free. There is no free money with annuities, only money that's going to come out of your hard-earned dollars and your retirement. Sold under suitability standard. I've talked about this many times, not only in my TV shows, but also my radio shows. Rezny Wealth Management is a fee-only fiduciary money manager. We legally have to work in our client's best interest. Did you know people that sell annuities work under the suitability standard? They legally don't work for you. They work for the annuity company they're selling the product for. They only have to sell you products you are suitable for, but may not be the best for you, just suitable. Not in your best interest is suitability. Often, no more than just a salesperson is who sells annuities. That's it. Limited education, other than an insurance license, is all that is required to sell you an annuity. Seniors, you need to protect your retirement. Don't be sold by false promises, and don't be sold by an annuity salesperson. Read the fine print. The problem is that fine print usually comes in a 200 thick prospectus that you, the retiree, receives once you actually purchase the annuity. Sure, there's a free look period of 10 or 20 or maybe 30 days, but at the end of the day, if you don't read the fine print, you're not going to know what you got yourself into. That's when the next problem starts, with a big surrender penalty to get all your money back out. Nobody should ever pay a surrender penalty, so you should never buy an annuity or any product that locks your money up for 10 or 20 years and requires big penalties to get all your money out when you want it. Read the fine print and read it twice. Unsuspecting seniors are often the targets for annuity sales, charlatans I call them. Don't be sold by a free dinner seminar. That free steak dinner invitation you receive in your mailbox once a month, those are annuity salespeople looking to get your money. Read the fine print. Annuities are not good for your retirement, and they're not good for your wealth. High expenses rob your potential returns, and it goes to the annuity salesperson and the insurance company. High expense investment products never belong in your portfolio, and annuities are amongst the highest of all investment products in the country on high expenses. Those high expenses lead to low returns for you, and ultimately you sacrifice your retirement and your opportunity for a better retirement by giving it to an annuity salesperson. Tammy from Naples, Florida. Is Europe on the verge of a turnaround? Where would you invest? Tammy, great question. First off, I will say this. We obviously are going into 2017. It's a new year. There's going to be great opportunity, in my opinion, in other places than Europe, specifically the U.S. Our new president, I should say, has policies that are pro-growth. That will significantly help the U.S. I would be more U.S.-centric in my investing, and I would also maybe add a percentage of your assets potentially to emerging market exposure. But I would stay away from Europe. Europe is slow growth or no growth at best. They're not on any verge of a turnaround at all, in my opinion. In fact, we heard about Britain leaving the EU or planning on it over the next year to year and a half. At the end of the day, it's going to take a couple years for that to happen. There's other countries in Europe that also will probably want to leave the Eurozone, which I think will be a net positive longer term. So maybe when Europe eventually falls apart, the EU is completely broken up, then at that point there might be 5 or 6 or 7 countries that are promising to invest in, but not now. In 2017, what we feel as a firm opportunity is going to be in the U.S. If we can grow this economy like our new president wants to, U.S. corporations should make more money. And remember, earnings drive equity-based prices. So ultimately, you want to be invested in the U.S. Stay away from Europe. If you own Europe, I would be a net seller of Europe, and I would look at U.S. mainly as a safer place to invest your hard-earned dollars, especially if you're looking for growth and equity-based returns. Sam from Naples, Florida. Are rising interest rates bad for stocks? Sam, That is a question I've actually received a lot over the last few months. If you've probably noticed, interest rates are starting to slowly move back up. And I want to use and stress the word slowly. Ultimately, if interest rates move up slowly, it really will not affect equity prices in a negative way or a bad way. Stocks can actually do quite well in a rising interest rate environment as long as rates do not go up too fast. Like remember back in Jimmy Carter days in the 70s. So ultimately what you want to do is if rates move up slowly because the economy is growing, that's actually healthy for equities. It's bad for bonds. So if you own bonds, of course, you're going to get hurt in the bond market. And depending what kind of bonds you own, whether they're longer term maturity bonds or shorter term maturity bonds, they will be affected differently. So interest rates going up, remember, if rates go up, bond values go down. But if interest rates go up slowly, equities can actually do quite well. And I feel there is actual good promise for U.S.-based equities here abroad in some of the emerging market exposure countries. Jim from Marco Island, Florida. How could the recent election affect the market? Are you making big changes in your clients' portfolios due to the President Trump? I'll tell you what, Jim, at the end of the day, the way the policies are administered by our new president, President Trump, will really dictate how the U.S. economy grows. I will tell you from what I've seen and the policies that they're talking about, reducing corporate tax structure, reducing personal income tax, these are all net positives. By bringing back quality jobs and creating fair trade within the U.S. is actually a net positive. So I look at the new president's objectives and his policies as very positive for the U.S. economy. Not necessarily as positive for other countries around the world, but again, America should always come first and foremost for all Americans. So the policies that are going to be enacted will help all Americans. It'll help the poor come up a notch, middle class, everyone. Pro-growth solves a lot of our problems, and it's going to help you ultimately be able to fund your retirement, your children's education, and so on. Without growing the economy, we become very stagnant, kind of like Europe has over the last 20 or 30 years. So I firmly believe these current policies are good for us. Have we made changes to our client portfolios? We were already positioned for a Donald Trump win. I felt over a year and a half ago in the primaries that Trump would ultimately win because I felt there's enough dissatisfied people in the U.S. who really have been left behind. So we were positioned as we already went into 2016, going now into 2017, that we felt were the proper areas. Areas like large cap and especially small cap in the U.S., we had emerging market exposure. These areas actually did quite well. That's not a guarantee to the future, but I was looking at the win already, and I wanted to be positioned for not only 2016, but also now going into 2017. Look at small cap, look at large cap, and I would look at some emerging market exposure. I've got to take a short break. I'll be back with more questions after this. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, reznywealth.com, and download your free report right now. Hello, this is the Rezny Wealth Report. I'm Brian Rezny. We're back taking your questions. Of course, you can send me an email question to brianrezny@reznywealth.com. And also, please visit our website, reznywealth.com. If you are looking to erase investment stress, if you're realizing your current broker is no more than really maybe a salesperson, and your portfolio hasn't done well and you're ready for the difference that Rezny Wealth Management provides, please call our office. Number's at the bottom of the screen. Visit our website, reznywealth.com. Become part of our family. We want to help you prosper in the future years and make sure your retirement is everything it should be. So again, if you're tired of bad service, bad portfolio management, it's time you experience the difference we offer retirees and pre-retirees at Rezny Wealth Management. You know, a little bit before I take my next question, again, we're going into this new year. Ultimately, anything can happen. We're going to see some short-term volatility like we did in 2015 and in 2016. And one of the things I talked about a lot over the last couple of years was recessions. Every time that we seem to get a 5 or 6% pullback in the market, you know, these Wall Street firms started yelling, recession, recession. They were wrong. Ultimately, Rezny Wealth Management was right. I've been talking about recessions and the fact we were not in a recession last year or in 2016, and I firmly do not see a recession in 2017. Now, that may change over the next couple months or the next couple years. We'll try and alert you the best we can, but we do a lot of hardcore research on how the economy is growing. We're growing at a nice even trend up. We should be growing better as we go into 2017 firmly with new policies on the pro-growth side. So we don't see a recession, but you're always going to get these garden variety pullbacks. Nothing goes straight up. You might go up 4 or 5 steps, come down a step or two in the portfolio value, only to take a break and go to the next high ground. That's how investments work. So again, if you're becoming more emotional, if you're worried about short-term fluctuation, maybe your portfolio is not being managed properly. And again, another reason to call Rezny Wealth Management. Brad from Naples, Florida. I have a large allocation of cash and I was unsure about the past election. That proved wrong. What would you do now? Brad, what I would suggest is you need to hire a real money management firm. Either A, you're not doing a proper job yourself, or the firm you're utilizing is probably not doing a great job either. I think a big mistake is trying to short-term time the market. I believe in risk management, meaning if we actually have a slowing economy and recessions, reducing risk there, but we're seeing no signs of that. What you basically did is an emotional decision to raise a lot of cash. Now the equity markets, let's say, are higher that you want to get into. Bottom line is you have to have an investment strategy and you have to follow it. If you don't follow it, you're never going to have a chance to make money, and you're going to be like the vast majority of investors that basically do very poorly on your returns because you're jumping in and out without any strategy, out without any knowledge, no direction, and you're basically doing it off gut and reactions, which has been proven bad for the management of your money and bad for your future returns. Fred in Fort Myers, Florida. I'm currently managing my own money and I'm having a tough time making timely investment changes. Do you have any recommendations? Fred, like my last question, I would say the same thing. It is very hard for most individuals to manage their own money. It sounds easy, but in real action, it is very difficult. You have to be talented, you have to have the knowledge, you have to have the strategy, and you have to be willing to get rid of the emotional side and make logical choices around your money. If you are unable to make timely decisions, it probably means, and again, don't take this the wrong way, you're just unable to really pull the trigger and manage your money yourself. Find a fee-only fiduciary firm to help you manage your money. That's what I told my last question. Call my firm. We'd be more than happy to sit down with you, review your portfolio. Managing money is not easy. It's time-consuming. It's tough. And you have to have the discipline in order to do it. And maybe you just don't, but I find most investors that try to manage their own money, they fall in that same boat and eventually they realize this isn't easy. I need to find a professional, but make sure it's a fee-only firm, not Wall Street, not a bank, and never an annuity sales person. Mel from Cape Coral, Florida. I own gold and silver coins bought many years ago from a commercial. I recently realized these coins are way undervalued. What would you do? First off, Mel, your question is spot on with a lot of other people just like you. Never, ever, ever buy gold coins from a commercial or gold. At the end of the day, most of those commercials are basic sales pitches and they overmark the price of those gold coins up. You buy them in hopes that they're going to go a lot further up, and what you're finding years later, they're not worth near what you paid for them. What I would suggest you do is go to 3 different coin dealers, 3 different ones. Do a Google search, find 3 reputable coin dealers, bring your coins into each one, let each one know you're going to 2 other dealers to get pricing, and then you're going to sell your coins to the best price. This way, the other dealers hopefully will give you the best price they can. Again, not all coin dealers are reputable. Try and do a Google search to find some that have some pretty good reviews, but I would ultimately dump your coins. People who buy coins professionally and spend a lot of time in research on coins, they can do quite well. The problem is gold coins are illiquid, it's hard to get information, and for the average person buying coins from a commercial, forget it. You're probably going to end up losing way more than you ever put into those coins. Tom from Punta Gorda, Florida. You were spot on with your advice on small caps the last few years. What overall returns from small caps versus large caps do you think will happen going forward? Tom, great question, and thanks for the nice comment. We did like large caps a lot over the last 3 or 4 years, actually, and they have done quite well. Again, not a guarantee to the future. I firmly still like small cap. We still own small cap in our portfolio. Under the policies that are going to be enacted or talked about by our new president, of course, those are very good for small cap companies. We're talking about fair trade and more trade in our country, and ultimately that does help small caps quite a bit. Large caps historically have not ever done, over longer time frames, have not ever done as well as small caps in general, because small cap companies can go up a lot faster, of course, than large cap companies can. I still think small caps are a place to have in the portfolio. Don't overload the boat. We still own them, and I still think small caps over the next 3 to 5 years will probably greatly outperform large cap counterparts. Larry from Naples, Florida. What exactly are moving averages? Are they a useful tool for making investment decisions? Yes, they are, Larry. We're talking about charting, by the way. If you don't use charting, if you're doing your own management, I think you're making a big mistake. We look at fundamentals as a firm when we manage clients' money. That's the under the hood stuff. And we also use charts and moving averages. Moving averages are useful because it gives you kind of an average price over various time frames if you get an uptrend or a downtrend in that asset category. As I've talked and tried to educate all investors, buying investments that are in an uptrend is always more powerful than trying to buy a stock that's going down in value thinking you're getting a bargain. You always wanted to buy into relative strength, and by utilizing charts and moving averages, depending which ones you're going to use in your strategy, I think it's a very useful tool, and it can help you make better decisions on what to buy and also what to avoid. Mike from Miami, Florida. What is your view on the equity markets? My view is actually quite positive. I think the U.S. market has a chance to do quite well in 2017 and the next 3 years after that. And we'll see, maybe Donald Trump will run again. It's the policies that matter, though, and I want to stress that. As I've talked repeatedly to investors over the years, I vote on policy and not the person. I'm a pro-growth guy. Growth helps the U.S. economy. It helps everybody if the economy grows. It helps the poor, it helps the rich, it helps everybody in between. It also helps pay for all the services that you need, Social Security, your health care. So ultimately, I think the equity markets look quite positive, especially with the growth policies we see. There's certain areas, as I talked earlier, I really do like small cap, don't overload the boat, and I like the U.S. overall. I would avoid Europe. I'd look at some percentage of my assets, maybe up to 10%, depending on risk and goals and objectives in emerging markets. But ultimately, I would keep the majority of my dollars invested primarily within the U.S. because we're going to be one of the stronger economies around the world, in my opinion, under these policies over the next 4 years. Of course, if you have any other questions, send them to Brian Rezny at ReznyWealth.com. One of the things I want to give a little bit of education about, and again, I think this is highly important for every investor. You, the investor, ultimately decide who's going to manage your money. You, the investor, ultimately have to decide how you should position your money for the future. As an investor, you have choices to make. You have a choice to hire a firm that actually manages your money, or you have a choice to hire a Wall Street firm or a bank or an insurance company who sells you investment product. I will tell you, 30 years I've been managing money. I've seen a lot of investment mistakes in my days. The biggest mistakes I've seen a lot of retirees and pre-retirees make is entrust the wrong firm with your money. I've seen so many people devastated by being sold crummy, expensive annuities from a free steak dinner seminar. I've seen so many investors hurt by Wall Street firms that sold them a bunch of crummy hedge funds or expensive mutual funds or manufactured products that those firms represented. I've seen a lot of investors hurt by not running a detailed investment strategy, which did not include managing the risk. Do you remember the year 2000 recession? How about 2008? How did your portfolio perform? Were you down 30 or 50%? Is risk management important? Is it an important part of your decision making? It should be. The problem is most people that have brokerage accounts and use the wrong person to manage their money have no meaningful risk management. It's buy and hold. It's asset allocation, that failed pie I talk about. It's buying expensive investments that ultimately take away from your net return. You, the investor, have to make important decisions about your retirement. And I think the most important thing to remember today is the average person that retires at age 65 that's married, there's about an 80 to 90% chance that one of you will live into your 90s. That's a 25 plus year retirement. If you have bad investment advice or expensive investments that take away your net return, that ultimately hurts your retirement. Investors today have to decide about bonds and stocks. Make the right choices with your portfolio so that you can prosper for the next 25 or 30 years. It's important you make those decisions today. Visit my website, ReznyWealth.com. Is your portfolio performing the way it should to meet your goals? Are you questioning the advice you're receiving? It's time you received a second opinion from a real investment management firm. That's Rezny Wealth Management. Experience the difference we provide. We're going to have another show, of course, next Sunday. Please call us at the number below. We'd love to talk to you and help you build a secure, safe retirement. We'll see you next week.